Hi, this is Randy Finney with the right side of the chart, and this is an early session update for Tuesday, July 15th, 2025. It's 10:51 a.m. Eastern Time, so I'm starting the video, and here's what we'll do in this one. Just going to take a look at some of the things I'm watching. It's another sleepy day in the markets. The broad market, the S&P 500, is about to go flat. Actually, just went flat. You can see in the top here, 0.001%. You look at the 1 minute chart, you can see the bots are playing. About the only ones playing in this market now. This is the that yellow line is the yesterday's close. You can see we went flat there. We just went flat and just went negative now. So again, a go nowhere day for the market. I expect most likely a red close. We recently finally broke down below those rising wedges there on QQQ, SPY, everything else. Little kickback rally afterwards, but again, I covered these in detail yesterday. You know the levels. I'm going to pull this line up. I'm just playing around with this. That should be right there at that gap. So you have this line here, about 512.90 is the previous highs, give or take, right there. If it takes that out, and I've always said this, it's not unusual when a breakout to new highs to come in, instead of making a perfect back test, they'll usually come down a little bit to blow out some of the weak-handed stops that are set too tight, or suck in some early short sellers that want to say the breakout's failed. Now, I do think the breakout will fail. Don't get me wrong. But all the better if we take out this level. That's 604 even. That's the top of that gap right there. Next level, 595.27. And again, the way it works, at least in my head, these are all check boxes. So you have a check box there, a check box there. And they increase the odds. And if you get out below that one there, that third checkbox, you have the 200-day moving averages, and this is big support here. I have purple yellow lines, but you can see the blue lines, the 200 simple and the 200 exponential. So that's it. So in the way this works, if you're so inclined, you could certainly take a short there. I told you on Thursday I started a short position, plan to add to that. We just need a little more evidence here. You know what? While I'm on the markets, because I'm going to get away, I'm going to share a trade idea, look at gold, the dollar, the things that I'm really watching that I think right now are probably the most important things to watch. But let me do this. Let me go to the website, as I often like to do, talk about the comment on the comments or any replies I made. So many charts all bearish. I would be surprised not to see a minimum of 5 to 10% correction. I think there's fewer times that I can recall in recent history. I'm talking this year, other than the Trump liquidation day where he stepped up the podium. We had a level that I identified before he got there, saying that's the lights out level. If that goes, boom, and we did. That was right from there. We broke that support, and then the biggest drop in many years came after that support level was taken out. I haven't seen a setup like we have now, in my opinion, since then. Meaning, I agree completely. A rip your face off, drop to the downside. In fact, it's funny because I commented right before, shortly a week or so before liquidation day, again, what Trump calls Liberation Day, when he stepped up the podium to first announce the tariffs. Who was it? America's favorite perma bull, Tom Lee, was calling for a rip your face off rally to the upside. And we got exactly the opposite. It ripped everybody's face off to the downside. He's calling for that again, but see, the market's broken out to new highs, but it's not ripping anyone's face off. It's barely, it's like a slug, barely, again, I've talked about the momentum waning. So, the media has been, of the consensus that I've gathered is this potential big blow off explosive top. Maybe, maybe not. We'll see. That's certainly not happened yet. But I'm going to say we have a better chance, in my opinion, because everyone thinks that's going to happen, that we could see exactly this, almost not a flash crash, but a very quick swoon down. The headlines will probably read, biggest 1-2 day loss in so many months, whatever else. And again, there's so many variables. I'm not going to sit here and list them all now, including but not limited to short interest being at or below 52-week lows on many key stocks and the indexes. the put to call ratio, the VIX, the posture of the VIX, the posture of the market, the low volume indicators that I've tracked and shared with you repeatedly recently with the 10-day moving average. There's a lot there. And again, you just need that simple catalyst. A catalyst, if you're building a campfire, you guys know the catalyst is a match or two rocks you scrape together, two pieces of flint. They're going to create a spark and light the tinder, which then lights the kindling, and then the firewood. So we need that catalyst, and God knows there's been enough potential ones. Markets have been shrugging that off, but the way it works is just all of a sudden one of them is it. Somebody talked about, maybe it'll be Powell. Trump's once again, he's jawboning Powell as he was doing before. He's got his mojo back. He feels like he's on top of the world. His stock market's at new highs, and like I said, I made a prediction that he's not most likely, knowing the man as best as anybody could, or think they can. He's kind of a loose cannon. I told you you can't argue he's got the big ego, and so I think the taco trade, since he was mocked and ridiculed about that before, I think he's less likely to cow down just due to his ego flying high right now. So we'll see, and that could be it right there. It's kind of like the boy who cried wolf. You guys know the Aesop's fable. So, he kept crying wolf. The villagers would come. Finally, they stopped coming. So I think it's the same thing in reverse here with the market, just kind of betting that everything he does will cow down. We'll see. We'll see. One other thing I wanted to talk to you about here on that is, again, there's quite a few check marks I'm looking for potential check marks. Sometimes you don't get them, just because somebody's standing over a puddle of gasoline with an unlit match in their hand doesn't mean they're going to light it, and doesn't mean they're going to drop it again. You need that catalyst. One of those potential, catalysts, as I've mentioned, is the 30-year bond. This is TLT. Which is the yield in reverse. This was multi-year highs, and we are, as I've stated, closer now again to spitting distance is what I call it. Spitting distance being just a bad day or two away. What I mean by that, when you look back on the chart, here's a few bad days in treasuries. That means rates were spiking there. And, so far, so good. Check. I've covered this chart quite a bit recently. We put in this divergent low. Treasuries trade as well to the technicals, at least my style, as anything that I've seen in recent years. I've had, like I said, batting probably 800 or more on treasury bond trades. And even when I'm not trading it, I'm giving you guys my read on the charts, and highlighted that last divergent low, and then the breakout and the back test. We went up, and that ran full circle. And just about 2 weeks ago, I highlighted this divergent high and gave you two levels that would trigger sell signals, and that was the first one there. We got that, hit my first target, and then we took out the second trend line. We back tested it. We've been moving lower, and so that is so far that's at least a very near-term trend reversal. And again, when I say spitting distance of new highs, if TLT goes down just to test the lows, we're only 1.88% away. Treasuries, good size move is about 1%. And so that is two average bad days and one really bad day away from breaking out to, again, not just multi-year highs. I know I'm beating a dead horse here, and I know it's a horse that may never, materialize. But if we do, this is it right here. I can guarantee you they will be talking about this on CNBC and Bloomberg and in the media, and probably even the NBC Nightly News when the 30-year Treasury bond breaks out. If it does, and I still think there's a decent chance. But the key is to react to it. If it doesn't, look, we've already come up and stared at the abyss. The abyss stared back. We pulled back. We tested that previous high right there. So we may do this. And again, I've talked on it many times. If it happens organically, that's net bullish. If it happens because that's a flight to safety, because the stock market's getting pummeled, that's not bullish for the market, obviously. That would be a slight flight to safety bid. But if this happens, I have, this I can, like I said, I can give you two scenarios if we get rejected here and yields pull back. One is, again, markets going down pretty hard. It's flight to safety bid. Institutions are selling stocks, buying bonds, treasuries. The other would be organic natural forces that bring down, expectations of longer term rates. Maybe even market manipulation to whatever extent the Fed and the Treasury can control the long end of the yield curve. Remember, they do not set that rate. It is set by market forces, but they certainly try to get in there and manipulate it. There's no arguing, no debating that. However, I don't have any alternative scenarios of this being anything but net bearish for equities. A breakout to new highs. That would be surprise, not shock, but surprise if we had a solid and sustained, meaning more than just a little brief pop and reversal breakout in yields that take us all the way back to where interest rates were, the 30-year bond, that is, all the way back to, as I've covered many times, and I'm showing you right here, take this line across. That is right there. That was the peak of the stock bull market in 2007, peaked at the end of 2007. The stock market technically was October. That was the drop in treasuries, the flight to safety bid, and the natural abatement in yields. There's two factors that go on in a bear market. Remember, that was the Great Recession, financial crisis, a lot of names on it. It was a 55+% drop in both the S&P 500 and NASDAQ 100. Took many of the big tech names down that you know about now, 60, 70, even 80%. And that was associated with a big drop in yields. And that is because, again, you have both a flight to safety, institutions selling stocks, moving to the safe haven of bonds, as well as expectations that rates will be lower when you go into a recession. That's what you expect. Slower economic growth, lower inflation. And so longer term rates tend to drop the most. All right, and that would also, like I said before, take you back to where rates were really back, all the way back in the beginning of the aughts, the 2000s. So we'll see. And again, it hasn't happened, but we're so close that I will, we get away here and we're moved back down here. I'm not going to be talking about this as frequently because there's, you're not going to break out from down here, a 3.7% yield on the Treasury. You're not going to go up in 1 or 2 days. But right now we're very close. And again, just keep an eye on it. So and of course, the Japanese 40-year bond, as I showed you, is there as well. Oh, the other big things I'm watching, and it's already happened. We broke out. The dollar is broken out. Maybe that breakout will fail. We'll see. But there's that 60-minute bullish falling wedge I gave you on UUP. Gold, silver, and GDX, I think, are not pricing this in yet. Maybe they're pricing in that it might fail, and if it fails, whatever. But I'm going off the charts. This is my type of pattern. That's textbook bullish falling wedge, and that also occurred off major long-term support right there. So if the dollar continues up, we're already seeing the miners and down today in gold, but again, not by a whole lot. There's GDX. I give you the levels recently. We need to take out that blue line right there at about 50.39. It's down 1%, nothing much, but it did take out that minor downtrend line I gave you recently, I think just yesterday. There's a little recent trading range, and so should the dollar continue to rally, which is my expectation, I think the miners and metals will continue to fall, gold, silver, in there. And then, as I mentioned, the VIX, or this is a proxy, VIXY, again, textbook little bullish falling wedge pattern, and just needs that catalyst. We had a divergent low and a bullish falling wedge right there, 127% rally. We had a bullish falling wedge and a divergent low right there, breakout, whatever that was. We hit my second target, we pulled back. We're still above the entry point on that original one. But again, this was a get in, get out trade. You don't hold VIX when you expect. Made it very clear back at the April 8th lows that the market was most likely to bounce. The RR was no longer, risk reward was no longer favorable to either take new shorts, even to stay short. And it was time to go long. So that now we've come back more than I expected. I gave you a target, a scale back in range. But at this point, this is where we're at now. We need to see this wedge breakout. That's on the daily chart, what it looks like on the 60-minute chart. We just continue to diverge lower. Divergence continues to build. And it's one of those things. It'll build until there's a catalyst that pops the the stock market, breaks the stock market down, and we'll see if this breaks out. But again, if it does, you have the targets. That's one thing I do, give them well in advance. If we get some kind of, especially if it's one of those let loose moments like I just talked about in the beginning of the video, where we have a quick swoon down, you're going to see position squaring like you hadn't seen in a long time. You're going to see hedge funds, mutual funds, individuals, stops get hit. And basically individuals and institutions will quickly swoon in and buy a lot of put protection to protect their downside. And that's what causes the VIX to go up. The VIX, you can look it up. The methodology is based on put call buying on the S&P 500. There's the actual spot VIX right there. This is what it looks like from a long-term chart. Again, big divergent low we're coming off of, and still off that divergent low on the weekly chart right there. That was the last one right here. All right. What else do I want to show you? Let me give you an idea. Let's change gears. So we'll see. Again, the market does what it does. It's just grinding up. Grinding up slower and slower now. That's what it looks like on a 60-minute chart. There's a daily chart. But what I want to show you here is a potential trade idea. Okay, here's one, especially if the market holds up. I'm not super hot on it, and it's well, actually, no, I shouldn't. Let me clarify. It's based on both technicals and fundamentals, but a pretty large fundamental component. I haven't marked this daily chart up. Be honest with you, I haven't even marked the chart up. These are old levels of trading this stock for a long time. This is SWBI, Smith & Wesson brands. I think most of you, especially if you live in the U.S., are familiar with Smith & Wesson. They make guns. Primarily, they make other things too, knives and other stuff, but firearms are the bulk of their sales. And it's coming up. But first of all, it's coming up on support. So right now, without mixing words, I can make a case to go long at support. The previous major reaction low, that was also a divergent low. My kind of setup, positive divergence. So right there, consider this a long trade idea now. I'll follow up with targets. I can just tell you, just eyeballing. These are old lines here. You can see I've had this line here since 2018. It's a level this stock has reacted on that far back. You can see the pop-ups. It's also still where, again, this one here, I've had it since 2019. These lines here I've had since 2018. You can see in the pop-up box. And it's amazing technical analysis. That's why I love it. That's why I sit here and do these long-winded videos. That's why I do this for a living. This is my passion. It's amazing how these levels work. I haven't tweaked or modified those lines in 7 years. 6-7 years, and they would be my first targets. That would give you to the first target there, roughly a 10% gain, then a 17% gain, and then a 31%, 31. And that would take us also up to these 200-day moving averages. They keep capping the stock here. It was in a bull trend here. By pullbacks to the 200, when the 200's lost, short rallies into it. And in a bear market, that's where you're going to come back to. So even if it's just a bear market rally, you're looking at about a 31% profit potential on this trade, minimum about a 10% if you're only targeting that first target. You can take it here at support. Yeah, it's a hair above the previous reaction low, but I don't get greedy. Just the same reason when I'm shorting a stock, if I see support at 822, I'm going to cover a hair below that, above that level. And when I'm long, I'm going to sell a hair below the resistance level that I give you on the charts in case the sellers step in early. No reason to get greedy and try to get that last fraction of 1% on a trade. Set a sell limit order or buy to cover limit order at your price target or targets. If you're doing multiple lots, some people will take a full position, scale out a third. Yeah, everybody's different. So, all right, so this is the technical case. If we look at a weekly chart, this is it as well. About 8:30 right there. There's that previous reaction low I showed you on the daily. You come back here, you had resistance and then a big breakout. And you can see again, the fact that this thing rocketed after that shows you that was a significant level right there. You also had some consolidation there and a big breakout candle. Again, this is a weekly chart. Huge rally from there. So I think this is a significant level resistance. And again, I've just made the technical case. We're also overbought at support. Take it, don't take it. If you anti-guns. Obviously, you don't want to take this one, but I'm going to tell you a little fundamental stuff too about this. I've always enjoyed. I have guns. I haven't been to the shooting range once in the past 15 years. Or I'm sorry, about a year ago for the first time in 15 years. I just don't have the time to go out there anymore. But I do, enjoy and have a collection of firearms. And been following the Trump's big bloated bill. For those of you not familiar with this or anything to do with the firearm world, what the general public calls silencers are really called suppressors. A lot of people think suppressors or silencers are illegal. They haven't been. They've been legal for years. You can buy one. You've been able to buy one for a long time. You don't need a permit on that, which a lot of people believe you need a permit or an FFL license or Class 3. No, all you have to do is, and had to do for a long time, is pay a tax stamp. The government, in their infinite wisdom, said, we'll just, we can't ban it, we can't make it illegal, but we'll charge a $400. It's called a tax stamp. And so basically that's it. You want to buy a suppressor, you can go to a gun shop and go to any of the online places to sell it, and pay the $400 tax stamp. And then you can have a silencer for your gun. Whisper quiet. So when you shoot the right ammo, you got to use subsonic ammo. If you don't, you're going to get that sonic boom. Anyway, so where I'm going with this is that in Trump's big bloated bill, one of the quiet little provisions in there is the federal tax stamp has been eliminated. However, this is, because I've been tracking this, you wouldn't think so if you didn't read the fine print on it. And where I'm going to go with this is a fundamental idea. This is one of the, as far as publicly traded companies, I did a little due diligence. This is probably the most direct play you can get on it, Smith & Wesson. They do make, they have one of the leading silencer brands or suppressor brands out there. All right, so let's go here to Perplexity. I use Perplexity Pro. I think this thing is the bomb when you for certain things. Google's still great for certain types of searches. There's ChatGPT. There's other things out there. But anyway, this is a list of publicly traded companies that manufacture firearm suppressors. A couple of these have been nixed, but you can still Smith & Wesson, one of the biggest. They own Gemtech. I can tell you they're one of the leading suppressor brands out there, and they bought them back in 2017. Sturm Ruger. Some of you are probably familiar if you own guns, these names. And these two have been nixed. I looked, and that's one thing about Perplexity and in any of these search engines. Some of these are outdated. These tickers aren't trading anymore. These companies got acquired, split off, and either way. So now these are your plays here. And I'm picking Smith & Wesson. Maybe we'll look at Ruger in a second, but I do believe Gemlux is more dominant. Now, I dig a little further. What percent of revenues comes from sales of suppressor for Smith & Wesson brands? And this is all they disclose. Smith & Wesson, they make 70% of their revenue from handguns, 22% from long guns. Those are your rifles. They do have AR-15 type weapons, things like that. And then other products and services is only 8%. So it's not going to move the needle huge. But again, I'm just sharing my fundamental ramblings here. That I think there'll be a big pickup, I think there'll be a huge surge. And not only that, I think the street's probably looking okay. So other products and services, again, you can look at the other things they make, and that's suppressors fall in that category. So on that, it might not move the needle huge. But look, you don't have to move the needle a lot on a company. I think right now they're sandbagging. I think these guys are pumping out as many as they can. That would be my guess. Because although the big bloated bill eliminated the $400 tax stamp, here, let me just show you, that doesn't actually happen. It doesn't come into effect. It was $400. This must be a typo. I'm almost certain it was $400. That's, I believe, a typo. You can look at that. I'll check that in a second. Starting January 1st. And so after that, you will no longer have to pay the tax. It's going to drop down to zero. But again, that doesn't kick in right away. Even though it's been passed, that's when it happens. So, okay, this is the This is the go-to. I've talked to gun dealers and people. This is the place you can go to. Like I said, a local gun shop, and they'll set you up with this. And this is online. They're considered the place to go. Best prices, best selection. A lot of people just go to the silencer shop. You can have it sent to a kiosk to pick up when you order it. And by the way, it is 200. I was thinking the 400 might be for a full auto or a short barrel rifle. There's other things you can do. You do need the FFL for the full auto. That's still they're going to stay there. Federal firearm licensor. But how to buy a silencer right here. And what I'm noticing again, this is the go-to. They're being completely mute about this whole thing, that the fact that it's going to be eliminated. They're still charging the $200 tax stamp. You can see here to purchase a silencer, and that is because it would just kill their business if everybody knows you can wait in January 1st. You don't have to pay that $200, and these things aren't cheap to begin with. They're usually $400 and up for a 22 caliber, whatever caliber you want. So I just wanted to mention that they're still charging that. Yeah, sure, these little promos, you can free tax stamp and gift card. Yeah, if you pay $800 for the silencer, they're just rolling it in. So what I believe is happening right now, or what I know, is that they have eliminated the $200 tax stamp, but only kicks in after the first. So I think there's going to be a huge spike. I know a lot of gun enthusiasts. And look, this isn't the thing of the hitman. And a lot of people, why do you need a silencer? You can, if you're a hunter, or even a recreational shooter, just to not have the super loud bang. And again, enthusiasts like those, I suspect there'll be a huge surge going forward when they eliminate that $200 tax, especially for an accessory that you screw on the end of the gun. Now, the other thing is, the way that works is you have to have a threaded barrel. A threaded barrel, at the end, and it has to be integrated into the barrel. So I think you're going to see a lot of an increase in both handguns and long guns. For example, Smith & Wesson makes the M&P 1522, which is a replica. It looks just like an AR-15, breaks down the same way. They do make an AR-15 style weapon, but both of those have threaded barrels. They make handguns, and more now, the newer handguns, because of this surge in suppressors among the shooting enthusiasts, are now coming out with the threaded barrels, but a lot don't have it. So I think they're going to see, and I don't think that's being factored in, you'll probably see an increase in sales in both long guns and handguns for people that want a suppressor but don't have a gun that currently has a threaded barrel. And that can really move the needle if so. So I think at bare minimum, you're going to see obviously a huge spike in suppressor sales once that $200 tax stamp drops off in January 1st. And again, this is probably your best pure play right here. So I made the case from a technical perspective, gave you some targets, may add to those. And then I also gave you the case fundamentally. And, come January 1st, I think you'll see like I said, these things will be flying off the shelves. And again, we could see, like I said, if I'm correct, you'll probably see an additional uptick in the sales of firearms. Plus, on top of all that, too, you have a gun-friendly administration. So, if it was still the previous administration, wanted to, Smith & Wesson, they do make a lot of assault-type weapons, or it's a big part of their lineup. So keep in mind that, at least the current administration is friendly towards that right now. And as I'm looking at this chart, it's just in my nature. I can't move on without adding. I need to add a trend line right there that may come into play. And that also aligns with that target, that roughly 30% target I give you. All right, let's move on. So I just wanted to kind of share the fundamental with the technical stuff and tell you I don't think that's priced in. And maybe it moves the needle, maybe it doesn't. We'll see. But like I said, if I couldn't make a decent technical case to buy the stock, I wouldn't do it. Stops would be commensurate with your preferred price target. If you're going for a 30% run, you can easily give yourself a 10% stop. That's a nice 3-to-1 RR. If you only want to make a quick 10% bounce, then yeah, you want a little bit tighter stop, maybe 3%. 4%. That's about it. I don't have a lot. There's just not a lot standing out right now. Nat gas continues to, power on. Nice trend reversal coming off that divergent low. I still very much like that one right now. Like I said, I'm just kind of recapping what I like. Silver, gold, and GDX short, dollar, US dollar long, euro short, yen short against the dollar, and or dollar long against the yen. This is the 60-minute chart of UNG. We're coming up on T2 right now. Remember, this one was right. T1 was hit here. A little pullback off T1 as expected. Jumped above T1, and we're coming up on T2. There's all your targets. And kind of just an FYI, I haven't updated them often because there's just not a lot of movement, but I still long-term still like the grains. That's wheat, corn, soybeans. This is that long-term chart of wheat I've been sharing for many months now. That's our secular bull market uptrend line. Comes back from, I think, the dot-com era right there, end of 1999 with that big divergent low right there. Start of 2000. And this is that trend line we pulled back to with positive divergence. It's not running yet, but it's still set up as one of the better looking, for, in the coming months, long-term swing trade, trend trade. And then corn as well. I still like corn and soybean. And sugar too. Sugar is the last ag commodity I shared as a long trade idea for you. This is my long-term chart, a weekly chart. We go all the way back again to the beginning of 2000 here in this chart. And what we look at right here, this line I've had here forever and a day, a support resistance level. It was support, resistance, resistance, finally a breakout. That big run ended with a divergent high, fell back down below it, resistance, resistance. There is a breakout, back test, run, and we've come back down to that level for the first time with the positive divergence that I like to see for trend reversals. So we had a divergent low there, we had a divergent low there, divergent low there, divergent low there, and we even had one right there. It's not marked, but that was a divergent low as well. So either way, and again, I threw that out to you recently, and what is it, SGG or CANE, one of those two got taken away. SGG I think is gone, but Kane, no, CANE, little typo there. And that's what Kane looks like right here. So it's at, again, long-term support. These ETNs do a good, not perfect, but good job of tracking the futures. I just showed you the futures, and that's it. This thing continues to hold support with big divergence. And so I still, and again, it's part asset allocation, diversification. They've been dead money trades for a while now, but they're still at long-term support. So still like those in the longer-term accounts. Okay, let me wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great